Hello everyone, welcome to the weekly lecture videos. This week our topic is equity markets and share valuation, and we are covering chapter 7 from our textbook. So as usual, we have several learning objectives in this chapter. So essentially we will learn about stock valuation and the factors that determine the stock prices. And we will see that how corporate directors are elected to office, how a stock market works, and we will also discuss different types of shares, their voting rights, and other features. Okay, so I will be uploading 3 separate videos on these 3 learning objectives. I mean, 1 video on each of these learning objectives. So in the first one, I'm going to discuss stock valuation. Okay. So let's start with return on shares and bonds. Okay. As in this chapter, we will learn that the dividends currently being paid are one of the main factors that we consider when we value ordinary shares. Okay. However, when we invest in a share, dividend is not the only story. We also need to consider the sale price. Okay. I mean, the price at which we expect to sell the shares when we are to value a share. Okay. So going back to chapter 1, if you can remember, we saw that the goal of financial management is to maximize share price. So an understanding of what determines share value is obviously an important concern. So when a corporation has publicly held shares, its shares will often be bought and sold on one or more of the major stock exchanges. For example, in Australia, that's Australian Securities Exchange, or in New Zealand, the New Zealand Stock Exchange. So we will examine how shares are traded. Okay. In chapter 6, if you remember, we learned about debt and its valuation, and we have seen that the debt's value or a bond's value depends on periodic interest and the principal. Okay, so as far as the stock is concerned, the value of a stock depends on its future dividends and also the selling price that we expect. That means the capital gains. Okay. So in summary, the value of any stock at a certain point in time depends on future dividends. Okay. Now you remember I said that it depends on future dividends as well as the price at which we expect to sell this. Now you know that investment in share could be a perpetual investment because share doesn't have a maturity value, and we may plan to hold it for an indefinite period. Okay, so if that is the case, then price of the share should depend on all future expected dividends. Now, even if we plan to sell it after some time, the price at which we expect to sell, that will again depend on the expected dividends beyond that point. Okay, so theoretically, the value of any stock should be present value of all future dividends. Now, how do we handle with this part? Because you understand that's easy to estimate future dividends for the few subsequent periods, for example, year 1, year 2, or year 3. However, how do we deal with estimation of dividends in distant future? We will discuss these points soon. So you see that to summarize this formula, the value of a stock should be the present value of all dividends. So dividend 1 essentially is the dividend that is expected to be received in year 1, then year 2, and year 3, and D0 is the dividend that just paid. Okay. So D1 to DT are the expected dividends. Okay, so let's discuss a bit more detail about how do we apply this valuation model. First of all, let's think about an 1 period example. Okay, Before I start these examples, you need to realize one point, that a share is more difficult to value in practice than a bond. Okay, and there are at least 3 reasons for that. I already indicated these points. First of all, with ordinary shares, not even the promised cash flows are known in advance. Okay, for bonds, you know how much interest you're gonna get, but for shares, you don't know how much dividend you will get. Second, the life of the investment is essentially forever. For a bond, you usually know the maturity, unless it's a perpetual bond, you usually know the maturity. However, for an ordinary share, there is no maturity. Okay, that's the second point. And third point is, there is also not easy to observe the rate of return that a market requires. Okay, that means, to find out the present values, you need a required rate of return to use it as a discount rate. And it's also not very easy to estimate this required rate of return. Okay, given these difficulties, the stock valuation model has been manipulated in different ways to address them. Okay, so let's see some examples. So in one period example, let's say that you are thinking to invest in a share and you expect to receive a dividend of $2. Okay, and you want to hold it for 1 year, and after 1 year you want to sell it at $14. That means your expected sell price is $14 and you require a return of 20%. That means the risk that you take by investing in this share, you think that you should get a 20% return on that. Okay, now how much price you should be willing to pay for this investment. So we find out the present value of dividends and the sale price. So $2 is the dividend, sale price is $14, and we divide it by 1 plus the required rate of return, and we see that we should be investing $13.33. Okay, so we invest $13.33, buy the share, get a $2 dividend, and sell it after 1 year at $14. We earn a return of 20%. Okay. Now let's extend this example to 2 period. Okay, so what if you want to hold it for 2 years? So you expect that the next year, don't forget that your previous year's dividend, you expected dividend was $2. Now, as well as the dividend 1, you expect a $2.1 dividend in year 2. And you expect that you will be able to sell the share at 14.7 at the end of 2 years. So you want to hold it for 2 years. So how much you should be willing to pay for this investment? So once again, what you do is look, you find out the present value. So this one is the present value of first year dividend, and this one is the present value of the second year dividend, as well as the sale price. Okay, and you see that you should be paying 13.33 to buy this share. You get the dividends $2 in year 1, 2.1 in year 2, and you sell it at 14.7, and you earn a return of 20%. And I think you understand why we don't have any power here and where we have 2, because this is the present value of year 1 cash flow, and this is the present value of year 2 cash flows. Okay, so that's a year 2 example. Now keep extending into 3 period example. Okay, so you expect a dividend of 2.205 at the end of year 3. That means you also have an estimated dividend of year 3, and you have an estimated sale price at the end of year 3. So we use a similar present value model here. So this is the present value of year 1 dividend, present value of year 2 dividend, and present value of year 3 dividend and sale price. And you see that you should be willing to pay 13.33 as you will be earning 20% your required rate of return given this cash flows. Okay, so I think you get an idea that if we have an estimated dividend and if we have an estimated sale price, then this is how we find out the intrinsic value of a share. Okay. Now, you have seen that we had an estimated dividend of year one, estimated dividend of year two, estimated dividend of year three. So you might have a question in mind that how we estimate dividends. Okay. Now, there are some straightforward way to do that, although in reality that might not be so straightforward. Okay. So look at that. If the dividend just paid was $2, and the farm expects a constant growth of 6%. So the latest dividend was $2, and you expect that the company will grow at a rate of 6%. So based on this information, we can estimate dividend in the subsequent years. So for example, you can see that when our D0 was 2, that is the latest dividend paid, our year one expected dividend will be 2 into 2.12. So it's 2 into 1 plus growth rate. So we are capturing the growth rate to estimate dividends. So year two dividend will be year one dividend, estimated dividend, then again 1 plus growth rate. Then year three is the D2 dividend and 1 plus growth rate. So you can see that based on the latest dividend and our expected growth rate, we can estimate the future dividends. Okay. Okay. Now, as far as growth is concerned, I think you understand that it may not be that straightforward. Okay, so that's why we consider some special cases when we estimate dividends. Okay. So to estimate dividend, what we need to do is we need to make some simplifying assumption. Okay. About the pattern of the dividends. Okay, and the simplifying assumption could be constant dividend or zero growth, and where the not constant growth, the constant dividend with zero growth. The next one will be constant growth. Okay, and the last one is non-constant growth. Okay, so when we are talking about constant dividend or zero growth, we expect that the dividend will be constant. Okay, for example, if last year dividend was $2, it will remain the same forever. That means a company pays same dividend forever. So if D0 is 1, then D1 will be 2, D2 will be 2, D3 will be 2, so dividend will be constant and there won't be any growth. So this could resemble to preference share because preference share usually have a constant dividend. However, an ordinary share can also have a constant dividend. Okay, and if this is the case, this is the simplest case of dividend, and in that case, we use a perpetuity formula. Why perpetuity formula? If you remember perpetuity from last week, we said that perpetuity means a cash flow stream where equal amount of cash coming at a regular interval for forever. Right now, when it's a constant growth, constant dividend, then it's same dividend. For example, $2 every year for forever. That's why we use it. Perpetuity formula. So dividend divided by required rate of return. For example, in this case, $2, if your required rate of return is 10%, then this is how you will be calculating the value of the share with constant dividend or zero growth. The next special case is constant dividend growth. Don't be confused between the last one and this one. Last one was constant dividend. So dividend is constant, no growth. But in this case, dividend is not constant. Dividend is not constant. Dividend will grow. However, it will grow at a constant rate. Okay. That means dividend will grow at a rate of, let's say, 5% every year. Okay. So in this case, how do we calculate the value of a stock? We calculate value of a stock as the present value of D1 dividend, that means the dividend next year, divided by R minus G. So R is the required rate of return and G is the growth rate. Okay, so this is how we calculate the value of a stock when dividend is expected to grow at a constant rate. Okay, we will see examples. Then another special case is supernormal growth. So supernormal growth means it's also called non-constant growth. Okay. So non-constant growth or supernormal growth means the dividend will grow at a different rate. Okay. So usually what happens is the dividend may grow at a higher rate for a few years, and then it settles down. Okay, then it becomes a constant growth. So which means that when we estimate the dividend stream, there may be some abnormal growth in few years, and then it's a constant growth. So it's a combination of abnormal growth and a constant growth. Okay, so let's see some examples. First of all is constant dividends. Suppose a share is expected to pay $0.5 dividends every half year forever. So you see that it's essentially a perpetuity because $0.5 every year for forever, and your required rate of return is 10%. So we use a perpetuity formula, dividend divided by required rate of return. Okay. And you see that 10% is divided by 2 because $0.5 is a half yearly dividend. So we divide the required rate of return by 2. And you can see that the value of this stock should be $10 in the market. So which means that if you expect that a share is going to pay you $0.5 dividend forever, okay, you should be willing to pay $10 to buy the share. Okay. Then constant growth. Look, Outback Limited just paid a dividend of $0.5. It is expected that the dividend will increase by 2% per year. Okay. Now you see that here the latest dividend was $0.5. The dividend will not remain the same. Rather, it will grow, but it will grow at a constant rate, which is 2%. So the formula is D0 into 1 plus, so P0 equals to D1. Okay, so D1 means what is the dividend you are expecting next year. So that will be the D0, that means current period dividend, into 1 plus growth rate. So you can see current period dividend is 0.5, 1 plus growth rate is 2%. Then R minus GR is the required rate of return and growth rate, and you can see that it's 3.92. So it means that if you expect dividend of $0.5 and you expect that it will grow at a rate of 2% and your required rate of return is 15%, then you should be willing to pay 3.92 for this share. Okay. So here is another example. Suppose Deep Pirates Limited is expected to pay $2 dividend in year 1, and your growth rate is 5%, required rate of return is 10%. So once again, very straight forward formula. This is the expected dividend in D1 R minus G. So you should be paying 13.33 to invest in this share. Okay. Now, share price and sensitivity to dividend growth. Okay, so you need to realize one point that growth rate, dividend growth rate is an important determinant of share price. Higher the dividend growth rate, higher should be the share price, right? So you can see that, for example, when your next period dividend is $2 and your required rate of return is 20%, as the growth rate increases, share price also increases. That means share price should capture the dividend next period and also your expected growth rate of the dividend. Okay. And also the share price is determined by your required rate of return. That means how much return you want to earn from this investment. And higher your required rate of return, then share price should be lower. Okay, I explained this point last week, that when you want to earn a higher return from an investment, you should be able to buy it at a relatively lower price. Otherwise, you can't earn higher return, right? So you can see that once again, when next period dividend is $2 and growth rate 5%, as your required rate of return increases, share price decreases. That means to earn a higher return, you must be able to buy this share at a relatively lower price. That means higher the price you buy, lower should be the return, and lower the price you buy, higher should be your rate of return. Okay. This is just another example of constant growth model. Okay. Just one point you need to remember that in some case you may be given D0, and in some case you may be given D1. For example, in this case, the company is expected to pay a dividend of $4 next period. So which means that you are already given D1. That means dividend next year. So you will straight away use this dividend in the constant growth model. Okay. However, if you are given D0, that means the latest dividend, in that case, you have to multiply it by 1 plus G to find out the expected dividend next year. Okay, so this point should be kept in mind. Okay. Now look, so far we have seen that what is the value of a stock at P0, right? At any point in time, we calculated that what is the price at P0. And you can see, if you remember the formula, P0 was D1 divided by R minus G. Am I right? Now, it might be possible that you want to find out your expected price in P1, P2, P3, okay? For what I'm talking about is P1, P2, P3 that you want to find out, okay? So keep it in mind, at any point in time, your price of your stock will be depending on next period dividend, and then you capture the required rate of return and growth rate. For example, if you want to find out what is the price at P1, that means end of year 1, then you should have D2, that means dividend expected next year, then R minus G, okay? And when you are finding out P2, the price at the end of year 2, then you should have D3, then R minus G. Okay, this is how you should proceed. So in this case, we are expected to find out the price in year 4. So price at year 4 should be the dividend of year 5, then R minus G. Okay, and D5, that means dividend year 5 should be dividend year 4 into 1 plus growth rate. Okay, so at any period, if you want to find out the price, for example, if you want to find out P5, then it should be D6. Okay, if it is P6, then it should be D7. So you have the expected dividend next year, and then divided by R minus G. Okay, and you also can calculate the implied return. Okay, implied return from this. Okay, we will discuss this point more detail soon. Now, just a couple of points about using this constant growth model. You see that we use constant growth model when we expect that the dividend to grow forever at a constant rate. Okay, which means so this is one condition, that dividend will grow at a constant rate. And so as dividend is expected to grow at a constant rate, share price should also be expected to grow at a constant rate. Okay. And also another condition is R must be greater than G. That means your required rate of return must be greater than G. If you remember the formula, for example, P0 divided by D1 R minus G, right? So if your R is not greater than G, that means your required rate of return is less than G, then you cannot apply this formula. Am I right? This is one point, and it's also not reasonable, because if you expect the dividend to grow, for example, at a rate of 10%, and your required rate of return is less than 10%, that doesn't make very good sense, because if dividend is expected to grow at a 10%, you should be expecting higher return. Right? So these are some conditions, some prominent conditions that dividend expected to grow at a constant rate forever. Share price is expected to grow at a constant rate forever. And also the required rate of return must be greater than G, which is the R must be greater than G. Okay. And you understand that since share price is expected to grow at a constant rate, and dividend is expected to grow, so expected dividend yield and expected capital gain should also be constant. Capital gain means the difference between your sale price and your purchase price. That means how much capital gain you have from selling the share. That also should be constant. Okay. And your expected total return should be expected dividend yield and expected growth rate, which should be constant because you are expecting a constant growth. Okay, now come to non-constant growth problem or the supernormal growth problem that we discussed earlier. Look, a firm is expected to increase dividends by 20% in year 1, by 15% in year 2. After that, dividends will increase at a rate of 5% per year indefinitely. So you see that in the first 2 years, they grow at a different rate, and then it settles down and it becomes a constant rate, which is 5%. The last dividend was $1 and the required rate of return is 10%. So how we find out the price of the share? I mean, the intrinsic value. Okay. So what we need to do essentially, we need to find out the present value of all future expected dividends. Okay. Now, theoretically, I can tell you that you should estimate year 1 dividend, year 2 dividend, year 3 dividend, and you find out the present value of all of them. And from year 3, as it becomes constant, we already know how to apply a constant growth model, right? Okay. So look at this. Our latest dividend was $1. Am I right? And our first year growth is 20%, second year growth is 15%. So since our latest dividend was $1 and first year growth rate is 20%, so D1 is expected to be 1.2, and the second year growth rate is 15%, so D2 is expected to be 1.38. Am I right? And from D3 onwards, it becomes 5%. So our D3 dividend is expected to be this. Okay. Now, how we find out the future price? Look at this. First, we find out what should be the price at the end of year 2. Why? Because at the end of year 2, that means from year 3 onwards, it becomes a constant growth model. So what we do is at the end of year 2, which is P2, the price depends on D3 divided by R minus G. So at the end of second year, end of year 2, the price should be 9.66. Okay. So now we are ready to find out the price at 0 time. So this is the present value of year 1 dividend. This is the present value of year 2 dividend and the price expected at the end of year 2. Okay. So the price at 0 time should be $8.67. Okay, which means that you should be willing to pay 8.67 to buy this share. So you get a dividend of 1.2 next year, 1.38 the year 2, and then it becomes constant. So if you buy this share at 8.67, then you're going to earn your required rate of return, which is 20%. Okay, so I think you understand this. So you find out the present value of dividends when there was different growth rate, and then use your constant growth model when the dividend is settled down and it becomes constant. So I think now you understand that how we apply this formula. So we estimate the future dividends for few years, and then we make a simplifying assumption that beyond that point, it should be either a constant dividend or a constant growth rate dividend. Okay, so we simplify it because it is not reasonable to estimate dividend in distant future. Even if we do so, that will not be correct. Okay. So we already know this constant growth model. So you can see that we estimate dividend for the first few years. Then we make a simplifying assumption beyond that point, and we find out what should be the price at the end of this period and find out their present value to get what is the price at 0 time. Okay. So I already said that after the supernormal growth period, we consider that whether the dividend will be constant or dividend will grow at a constant rate. Okay. So this is just a timeline of the example that we have seen. So you see that year one dividends, this is the present value, then this is the present value of year two dividend, and this is the present value of the price we expect, an estimated price at the end of year two. Okay. So these are some examples you should be practicing by yourself. Okay, so first one is a constant dividend model, and the second one is a constant growth problem. So these are very simple and very straightforward. Now, so far we found out the price. Okay. Now, what if we know the price and we want to find out our required rate of return? Okay, so we can rearrange the formula and we can solve for R. So this was our price formula, so D1 divided P0 equals to D1 divided by R minus G. So if we rearrange this formula, it will be R, the required rate of return should be equal to D1 divided by P0 plus G. Okay, so you might think that, okay, how do we find out P0? Look, the P0 that we are so far calculating is our estimated price of the stock. But as a stock is traded, we always have a market value of the stock, all right? So if we take the market value of the stock, we have an estimated dividend of next year, and we have a growth rate, then we can solve for R, we can solve for the required rate of return. So these will give us an idea that given this market price, the market is actually expecting this return from the investment. Okay, which means, I repeat, if you see that this is the price at which a share is traded, you have an estimated dividend and you have a growth rate. So calculating R means these will let you know that what is the rate of return the market is expecting from this investment. Okay. So look at this example. A firm shares are selling at $10.50. That means that is the price of the share in the secondary market. They just paid a $1 dividend, and dividends are expected to grow at a rate of 5%. What is the required rate of return? So you just use that rearrange equation. So a required rate of return equal to 1, which is the latest dividend, into 1.05. So that's the 1 plus the growth rate, and divide by the current share price. Okay. So this is the growth rate, and you see that it is 15%, which means that if the share is trading in the market at 10.5, and they have paid a dividend of $1 last year, and there is an estimated growth rate of 5%, it means that investors want to earn 15% return from this investment. And that's why the share is selling at $10.5. Okay. So this is just a summary of what we have seen so far. This is constant growth case. This is non-constant growth rate case. Okay, and this is a general case. And as we have seen that we can rearrange the equation to find out expected returns. Okay. So that's our end of discussion in this video. So essentially we learned about the stock valuation, how we find out the value of a stock, considering some special cases and considering a general case. Just one last point before I finish. As I mentioned that when we calculate P0, that is our estimated price. Now, how we use this information to make an investment decision. So what we should do is, once we have this estimated price, we should compare it with the current market price. Okay, and if we see that current market price is less than our estimated price, it means that the share is underpriced in the market, so we should invest in this. Okay, on the other hand, if we see that the current market price is higher, okay, it means that the stock is overpriced in the market. So we shouldn't invest. Rather, if we currently hold them, we should sell them. Okay, because its price is higher than what we anticipate. So the price should decline. And before that, we should sell them. Okay, so this is how we used our intrinsic value of the price with the current price, and we decide whether to invest or not. Okay, so thank you very much for watching.